So, as I'm recording this video, the stock market, well, it's coming off its biggest one-day drop since the pandemic hit in 2020. Now, many experts, they're pointing to President Trump's new tariffs on U.S. trading partners as the reason for this big drop-off.
April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy.
Now, if you're retired or you're planning to retire soon, this kind of market drop, well, it could hit you harder than most. And that's why in today's video, I'm going to be sharing 5 smart moves that you can make right now to help protect your savings from further losses. And these steps, well, they're especially important if you're in what financial experts often call the retirement danger zone. I'm Lou Reyes, and welcome back to Over 50 TV, where we talk about smart ways to protect your retirement, grow your income, and prepare for life after 50. Now, today's video is about urgency, but it's also about taking action. If our topic, if it hits close to home, well, I'd love to hear how you're navigating this market. And if you want to stay up to date on the news that matters most to you, well, I invite you to sign up for my free breaking news email. I'll send you essential updates, and I'll send them straight to your inbox, and I'll send them as the news happens. Just click on the link in the description to get your free copy of my breaking news email. All right, so now let's jump into the 5 smart moves to help you stay financially strong no matter what the market does next. Create a cash buffer to avoid selling in a down market. Now, if you're close to retirement, or maybe you're already there, well, market drops like this, well, yeah, it can do more than just dent your portfolio. They can disrupt your entire plan because when stock prices fall and you need to withdraw funds for living expenses, well, you could be forced to sell more shares just to meet the same expenses. And that leaves you with fewer shares to rebound when the market eventually recovers. And that can make a serious difference in how long your money lasts. Now, to reduce that risk, many financial advisors, well, they suggest that you move enough money into stable, low-risk cash investments like money market funds or short-term treasury securities to cover 2 to 3 years worth of withdrawals in retirement. And that way you won't be pressured to sell investments at a loss just to pay the bills. Instead, you can ride out the downturn with some peace of mind. Now, you might also want to consider lining up other sources of a backup income like an annuity, a home equity line of credit, or even a reverse mortgage if you've built up significant home equity. Now, this is a good time for me. It's a very good time for me to mention the information in this video. Well, it's for educational purposes only, and it does not constitute financial advice. Please consult with a certified financial planner or a professional advisor before making any financial decisions. Rebalance your investments, but don't bail out of stocks. After the sharp gains in 2023 and 2024, your portfolio, well, it might be too stock heavy, and that can be risky in a downturn. Now might be a good time to rebalance your mix and consider shifting more of your assets into bonds, which have historically lost far less than stocks during market declines. Now, some financial planners, they'll suggest that you have 5 to 7 years worth of projected expenses in low-risk assets like cash and bonds to help you cushion the impact. Now, that said, I think most financial advisors will also tell you stocks remain the best long-term defense against inflation. Now, trying to jump in and trying to jump out of the market can backfire badly. Now, according to JP Morgan, if you missed just the 10 best days in the market over the 20 years from 2005 to 2024, well, your returns, well, they would have been more than 40% lower. Timing the market's not a strategy. It's a gamble. Scrutinize your spending. Small cuts can make a big difference. Whether you're still working or already retired, cutting back, even temporarily, well, it can help protect your savings and cushion the impact if a recession hits. Take time to scrutinize your budget. Are there any expenses you can pause, scale back, or maybe even skip altogether? Some experts, they recommend using a guards rail strategy, which means withdraw just 3% from your portfolio when markets are down and increase to 5%, only 5% when the market is strong. These small adjustments today, well, they can mean a lot more security down the road. Have a plan B and a plan C ready. When markets are shaky, it's not just your finances that take a hit, it's your confidence. Your confidence can take a hit too. Now, one of the best ways to stay grounded is to have multiple backup plans for your retirement lifestyle. Think of it this way. You're not just choosing a single path, you're preparing a few flexible ones. You can start by picturing three versions of retirement. Let's start with your ideal plan. Now, this is the version you've been working toward. Maybe it includes travel, maybe dining out often, or even helping the grandkids with college. This plan reflects the lifestyle that you want most. Another plan, what we call the practical plan. Now, this version scales back just a little, maybe fewer big vacations, some budget friendly entertainment, and less discretionary spending. It still reflects comfort, but with an eye on your long term sustainability. Another plan we call your safety plan. Now, this is your just in case option. It's the version you could live with if the economy gets worse. Downsize your home, cut down on non essentials, or find a part time income stream to delay withdrawals. It's still fulfilling, but it's more financially cautious. The goal isn't to lower your expectations, it's to know you have options that are still enjoyable even if circumstances change. It doesn't mean giving up on your dreams, it means protecting them by staying ahead of uncertainty. Work a little longer if you can. Delaying retirement, even by a year or two, can have a huge impact on your retirement savings. It gives you more time to save and fewer years to rely on those savings. Now, if you're already retired, a part-time job or maybe a side hustle, well, it could help delay withdrawals and give your portfolio time to recover during these challenging economic times. But if working longer, if that's not an option, well, consider other ways to adjust. We've talked about downsizing and cutting back on expenses, or you could just reshape your lifestyle to fit your values and your budget. The bottom line, Trump's sweeping new tariffs stacked on top of previous levies and global retaliation, well, it's all expected to drive up prices on everyday goods. Now, these escalating trade wars, they've already roiled financial markets and they've thrown many businesses into a cloud of uncertainty, just as economists are warning about slower growth and rising inequality. Now, there's no doubt we are in unpredictable, uncharted territory, and that's exactly why now is the time to act. The steps that you take today could help protect everything that you've worked so hard to build. Drop a comment below if you're making any of these moves or if you have a question. Now, before you go, you're invited to sign up for my free breaking news email. It's really the best way to stay informed about the news that matters most to you. Now, I send you essential updates. I send them straight to your inbox, and I send them as the news happens. Just click on the link in the description to stay informed. Now, if you want to learn more about smart money moves for life after 50, click the link in the corner of this video to watch more in-depth reports and expert analysis that could impact your retirement. And don't forget to subscribe to Over 50 TV for more updates and real-world advice to help you thrive after 50. Thanks for watching. I'm Lou Reyes, and I'll see you in the next video.